Good morning, good afternoon, good evening, whenever you are watching this week's video. Hey, it's been a couple weeks since I put a video out. We did the monthly at the beginning of May. Then stuff got to happening, right? And I haven't done a podcast. I haven't actually done a weekly, but now we're back at doing weeklies, right? I told you I needed a pause because, drum roll, please. I don't know if y'all can even hear that drum roll. We are talking about passive activity. Mainly, we're going to start with real estate, right? This week. So I'm going to go into a series where I break this down because I've had several different people ask me this question. And I really want to make sure I explain the distinction between how real estate and other passive activities actually work, give you some insight as to what's coming down the pike, actually what has landed in the building, and new things that will be happening as we continue to build on our series and talk about how things are going to be fully impacted by the One Big Beautiful Bill. I actually did get in my email recently some training on or some information that was like, hey, all right, they over there updating stuff in the IRS. Over the last 6 weeks, they've given us more guidance on what to expect when it comes to One Big Beautiful Bill. So I'm kind of excited about that, right? For those of y'all who are like, who is this girl that is chatting and don't nobody introduce her to me properly? My name is Patrice L. Berry, EA. That EA stands for Enrolled Agent, right? Meaning that I specialize in all things tax. I am an accountant by trade. So for those who are like, oh, she just prepared tax. Oh, that's the tax lady. I do more than just taxes. I am a full-fledged accountant, even though some days I'd be like, God, am I really a full-fledged accountant? I have a degree in accounting, a bachelor's and a master's. I am an accountant by trade. I love handling things with tax problems, breaking stuff down, because it reminds me so much of when I was an auditor and I was a federal auditor for 20 plus years. Okay. So that gives you some background as to, well, who is this chick talking? What is she saying? How is she doing all the things? I need to make sure I need to give that reminder because some people be like, oh, that's just the lady who just do taxes. No, I like to lead with taxes. But do I understand all the nuances that go into everything? Yes, I understand principles of accounting. There's aspects I don't like, but I understand the principles of accounting. I am an accountant. I just focus mainly in the area of tax problem solving, and really doing education for small business owners so they understand how to make moves out here. All right. So, off of that speech, let's jump into this week's breakdown. All right. Y'all know I got a presentation for y'all because I feel visuals help. Let's talk about it. IRS Publication 925 as of 2025. All right, so y'all know I'm pulling this stuff directly from the IRS.gov website. Why am I pulling it from the IRS.gov website? Because y'all know that's one of my favorite websites. I like to go to the source. I told y'all, former auditor. We got to go directly to the source. No Wikipedia, no person's website, no reel that somebody else explained. We're going directly to the source and we're going to break this thing down. All right, so passive activity and at-risk rules. This publication, 925, and we'll make sure you get a link to publication 925, covers 2 sets of rules that can limit how much you're able to deduct for trade, business, rental, or other income producing assets. Most people are asking me this from rental, but just so you know, this is what the publication, it covers more than just rental income. It covers passive activity losses, okay? Meaning that you're not actively doing stuff in here. The at-risk rules must be applied first. Well, how much is that loss is at risk? If a majority of it is at risk, if not, actually go and pay attention to your Schedule C's, and you'll see there's a box on there that says, hey, how much of this loss is at risk? Followed by the passive activity rules. Okay, and then we talking about what's going on in 2025. All right. So next slide, Patrice. Passive activity limits, the basics. Who gets to use these rules? Individuals, estates, trusts, personal service corporations, closely held corporations. Rules also only apply to owners, right, that are partners and the shareholders within the S corporation. So not the entity itself. And so if you've never heard me break down what the entity breakdowns are, that may be a tad bit confusing, but essentially what we're saying is that the entity itself right? All these entities, individuals, estates, trusts, C corporations, those are entities, right? But then partnerships and S corporations are pass-through entities. And so therefore the individual partners or the shareholders within that S corporation, those are the people that it will apply to. So you won't see it on the partnership return or the S corporation return. You'll see it show up on those individuals 1040 when it talks about the passive activity limits. Even though we capture some of it, that's why those returns get K1s, because we take that information and we capture that information on their personal tax returns. All right, there's two kinds of passive activities: trade or business activities in which you do not materially participate, right? Then you got rental activities. Let me let you see my face. Even if you materially participate, there's some limits, all right? Unless you qualify as a real estate professional. So we just talking about what the first levels are. We'll talk about real estate professional and break that down a little bit, but I'll go into it in more details because that's the people that be asking me stuff like that. Generally, passive activity loss for the tax year is not allowed except under the special allowance, and that's $25,000 for rental real estate. So my clients that fall into this category, they'll see a passive activity form show up on their 1040, and you'll see I'll talk about the explanation. Some of them have passive activity loss carry forwards, and then we'll go through that. I'll go through that explanation and be like, hey, either you cap out or you don't. Yes, we get to take a portion, or yeah, we gonna take all of it, and you're capped out at this 25,000, and then y'all remember me. I'll tell you, hey, so your queen and her cousin phase you out at 150. This is why I called the AGI the queen, right? Because she phased you out of stuff. So, and normally the dollar amount for a lot of those phase out is $150,000. All right. Cool. Next slide. All right. Special $25,000 rental real estate allowance. If you or your spouse actively participate in passive activity real estate, you can deduct up to $25,000 for the passive activity loss against non-passive income. Now, this is like matchy type stuff, so keep that in mind. Passive activity is used to offset non-passive income, not always active income. All right. So maximum allowance for non-passive income is what? Because now I'm talking, okay, passive income is real estate. And real estate is always passive unless you qualify to be a real estate professional. Non-passive income is your ordinary income. That's your W-2s. You understand what I'm saying? The other passive income we talk about is capital gains, stuff out the stock market, investments in oil, that type of thing. All right? Let me know if that makes sense. If it doesn't, and you need more explanation, let your girl know. Okay? All right. So the maximum allowance for singles or married filing jointly with their modified AGI, that's your cousin, under 100,000, 25,000. Married filing separate, we cut that in half, 12,500. Phase out, we start phasing ourselves out at 100,000. We fully eliminate it at 150. So it starts to, take it down. I'm not going to sing that. Get it together, Patrice. Act like you know. Okay? We started at 100,000. It's completely gone at 150,000. And then we have a passive loss carryover. Okay? Phase out example. You see this down at the bottom? $120,000 salary plus 31,000 rental loss. Look at, we start to phase ourselves out between 100 and 120. We do some reduction of it. We got a $10,000 adjusted allowance, 15,000 we get to take. 16 got to go forward to 2026, meaning we not getting this full 31,000. We not getting this full 31,000 to offset this non-passive salary. We only going to be able to use a portion of it, 15, to offset this, getting us down to we'll be carrying forward, well, what we setting off on the tax return as to be 105, which we like. That's gonna make the queen end up being 105. She come up there, she phase you out, then you get to carry her forward. Okay. Now, material participation. There are 7 tests you got to pass. A trade or business activity is not passive if you materially participate. Now, this is just not for real estate, but a lot of times we focus on the 7 tests for real estate. You qualify under any one of these tests. You got to have 500 plus more hours that you did in this activity. Right? That's material. Substantially all. Your participation was substantially all participation by all individuals. So you in it. And a lot of times I have people where it's just one individual. So in most cases, you can meet the substantiality test. 100 plus hours where you participated. At least as much as any other individual. So let's say you hired. Oops, I went back. I went too fast. Let's say you hired some subcontractors, or you had some employees that work with you. You gotta participate 100 plus more hours, or 100 plus hours, at least as much of those people that was on the clock. This can't be your side hustle. I'm running this, but I got a full-time job and I'm not really clocking hours. They just doing everything for me. Okay? Significant participation. Activity is a significant participation activity. Combined SPA hours exceed 500. So now we're looking at what our window is. 5 of prior 10 years materially participated in any 5 of the 10 immediately preceding tax years. So how long have you been doing it? And it takes some people a while. So we wouldn't automatically remember any one of the tests. We wouldn't automatically hit this one necessarily, right? Personal service activity in which you materially participated for any 3 prior years. Okay. And I know y'all gonna come back and be like, what's personal service activity? So we're gonna break down these 7 tests at a different time, but remember, this is my introduction to it. Facts and circumstances, regular, continuous, substantial bias applies if none of the above are met, but requires more than 100 hours of participation. Y'all, what does this mean? In other words, if somebody were to question it and say, I don't think you do this, you need some documentation for your hours. How do you do this? If you don't have a timesheet, you may have a planner. And we'll talk about this more. You may have a planner where you be like, I did this way. Or I have some clients that keep a spreadsheet and say, hey, this is the time I was working on this business activity versus this business activity. Or this is what I did with real estate, and these are my hours, and they keep their log. Okay? So, in other words, document, because why wouldn't you? Now, real estate professional status. Y'all just saw we had 500 hours on there. Notice, more than 750 hours of service during the year in real property, trade, or business in which you materially participate. What do this mean? Don't be out here, right, without your documentation. That's what it means. Make sure you documenting these hours. More than half of personal service performed in all trade or business were in real property, trade, or businesses in which you materially participated. So here's some real property activities. Development or redevelopment, construction or reconstruction, acquisition or conversion when it comes to real property, renting or leasing when it comes to real property, operations or management. So you have some real estate management companies, right? They qualify as real estate professionals. And brokering. A closely held corporation qualifies if more than 50% of gross receipts came from real property, trades, or businesses in which it materially participated. So if in that C corporation, if most of the money, right, 50% of the gross receipts that came in were from real property, trades, or businesses, then that C corporation that is going to, a closely held corporation is going to qualify. Employee services don't count unless you're a 5% owner of your employer. Spouse services don't count toward don't count towards qualifications, but do count toward material participation. Now, the reason why you hear that about spouses is because somebody else may work, and you'll see some of these videos on the internet where they talk about, hey, you work a full-time job and the spouse, be it male or female, the spouse goes and is a real estate professional because they went and got their real estate license and they out here, actively going to sell houses. Not just they got a license and they set it on the shelf and they ain't trying to sell no properties, right? And you'll hear that. So that's why that spouse piece is coming in, because you'll be like, okay, and you do this, and then my wife qualifies to be the real estate professional, or my husband qualifies to be the real estate professional because my husband actually got a real estate license and he or she is out here selling properties and making a living, in that profession, actively as a real estate professional. And we own property, right? And what does this do in reality? The reason why we're talking about these qualifications, and we'll get into more detail and get some examples, is because when a person qualifies, right, under the real estate professional, they meet all the qualifications, have the hours, etc., then they are able to, they don't have to live to that $25,000 passive activity limitation, because this is actively what they're doing. This they trader business. And so the biggest thing to remember is real estate is always considered to be passive until it's not. That's the best way to look at it. Real estate is always considered to be passive until it's not, based on the fact that you qualify as a real estate professional status. Let that sink in. Hey, so I'm popping in right here, and we're going to pause this right here. Why? Because you've been listening to me talk for about 17 minutes straight, and it's been a lot of information. I know. But I talked to the team. The team said, Patrice, you're going to have to cut this and make a part 1 and a part 2. So we're going to end it for this week. And next week, I want you to run to the mailbox. That's your email box. And listen to part 2. And if you got questions after listening to part 1, don't be afraid to send us a message so that I know how to break stuff down when we get to part 3 of the series and moving forward. All right? Enjoy the rest of the week, y'all. Have a great Memorial Day weekend. Peace, y'all.